Travis, busy time. It's a busy time of the year. Fed policy shifting and the presidential election is less than a month away.
Really?
Yeah, I know.
Has there been any commercials on?
Turn the TV on for a second. Busy times can unsettle investors either by fear of losing money or a fear of missing out, which we've talked about.
Twin fears.
Yeah, the twin fears. What investors don't seem to think about enough during an active market environment is gaining that wealth slowly.
Yeah.
People forget that very quickly. It's like the tortoise and the hare, we all know how that story ends, right?
Yeah, Steve. I mean, there's a kind of a famous conversation between Jeff Bezos and Warren Buffett. And he asked Buffett, why don't people just copy your simple investment philosophy or investment advice? And Buffett's response is, well, people don't like getting rich slowly. Everyone's after getting rich quick, and it generally doesn't work like that, right? So while many people think in weeks or months, elite investors like Buffett or Seth Klarman, they think in decades. Yeah. And people seem to be drifting further and further away from long-term thinking when you look at the stats. So if you go back to the 1970s, the average holding period for stocks was about 7 years. What do you think it is now?
A month?
It's 6 months.
Oh, it's under.
So 6 months from 7 years back in the 70s. So that's not a long time.
It's not at all. And we can thank technology advancements and high frequency trading for shifting the average holding periods, can't we?
Yes.
Technology is great, and then sometimes it isn't.
Yep, right.
A study from JP Morgan found that only about 10% of trading is now done by fundamental discretionary traders.
It's crazy.
That's just crazy low. When we started in the business, it's probably just the opposite. It flipped.
Right. It absolutely was.
And the rest is driven by quant funds and high frequency traders. And don't forget social media and the commission-free platforms. That just threw fuel on the fire for these short-termisms.
The short attention span that social media promotes, and now there's no friction like cost to trade, and you can see that holding period even shrinking more and more and more.
Absolutely.
Now, so. In short-termism, Steve, it's found in the markets like you just pointed out, but it's also found in C-suites of public companies as well. Pressured to deliver quarterly results, executives will often prioritize short-term results or short-term gains over creating long-term value for their companies. If you go back and read some of the better CEOs' letters, like Bezos, we mentioned Bezos and Buffett. He famously would say, this quarter was baked in a long time ago. Like I'm thinking 5, 10 years out, and not all CEOs, will think like that.
No, well, and that's why so many private companies, which we've talked in the past as well, or public companies want to go private, don't they?
Yeah, they'd like to stay private because they wouldn't have to succumb to those short-term pressures, right?
Absolutely.
So it'd be nicer to think longer term than short term. But the bottom line here, Steve, is the increased activity in your portfolio generally doesn't add value if you go back and look at the studies. Yeah. And we always ask ourselves, will this short-termism continue? It's very likely. It might even get shorter than that 6 months.
With technology, AI?
Yeah. But it does remind me of another famous Buffett quote, and he says, the stock market's a device for transferring money from the impatient to the patient. Yeah. So perhaps the single greatest edge that individual investors have over Wall Street right now is just having a long-term orientation versus focus on the short term.
So true, Travis. It's been great. I look forward to it next week.
Forward to it as well.